Hey, I'm Jason, and this is the Supply and Demand Daily, where I tell you what we learned about the economy today. I only have one indicator for you, and that is the Consumer Sentiment Index. And the reason I only have one indicator is because that's pretty much all that came out today. It's Friday, May 13th, 2022. So here we go. Consumer sentiment is down significantly in May, down significantly to historically low levels. And we'll see just what those comparisons are here in a couple minutes. But let's look at what the numbers are. So the number that came out today, early May, we're sitting at a level on the Consumer Sentiment Index of 59.1, and that's in comparison to 65.2 in April. So a pretty steep drop there. I read somewhere that it was 9-something%, and I didn't do the calculation myself. So if you can do percentages in your head, congratulations. Go ahead and correct my math. But I'm going to go ahead and just keep trucking along here. So the Consumer Sentiment Index is down considerably. And before we go any further, I just want to give you an idea of what the Consumer Sentiment Index actually is. So this is a data point that is released on a monthly basis, and you usually get the index the same month for which it was collected. So we're talking about May, and it is May. So that's one thing that's kind of nice about this. But it is collected, tabulated, and released by an institution called the University of Michigan, specifically their economics department, and they do so by using a survey. What the index is designed to measure is, let's say I just wanted to see one number that could give me an idea of the average feeling, the average optimism or pessimism of the average American consumer. And this is valuable economic information because the average American consumer is coincidentally the average American worker. Most people, in order to consume, also have to produce, and most people do that by working. And so by asking people questions about their opinions and their views and their outlooks on the economy, we learn something about how people on the ground who are close to the job market and interacting with the economy in several different kinds of ways. Everybody has a different glimpse into the economy based on their industry and stuff like that. So we see a glimpse of how the average American consumer is getting along and how they feel about their economic prospects. And that can be, that usually does a pretty good job of anticipating economic downturns where the economy actually shrinks and the human standard of living goes down. And we'll look at a long run chart that kind of shows that here in a minute. But to give you an example of how this works, the economists at the University of Michigan, they actually sent out a survey. And it's done over the phone as far as I understand it. And they ask the consumers who are in the sample a set of questions. It's about a 13-page long survey, but it goes a lot quicker than that, I'm sure, in the phone conversation. But I just pulled one example of those questions because this is one of the, I guess, one of the more important aspects of it. So here's one of the questions. The University of Michigan survey economist will ask the consumer in the sample, 5 years from now, do you expect that you and the family members who live with you will be better off financially, worse off financially, or about the same as now? And then they give them some answer choices as far as ways that they can answer that question, kind of like a multiple choice quiz. And then what happens is, so we have a lot of different questions that kind of follow this same feeling. How do you feel about what inflation's going to do? That's another one. Your inflation expectations for 5 years and 1 year out. And those are both questions on the survey. And so what the University of Michigan then does is they take all of these results and they give each question a numerical score, and then obviously bring those together and aggregate them through the entire sample of respondents. And so that gives us a number of, which ended up being 59.1 for May, but it gives us a number that allows us to just get a snapshot of the positivity or negativity of the consumer in the American economy and what they expect and how they feel about their economic prospects. So some highlights from this month's survey were that 36% of respondents attributed their negative economic outlook to the current situation with rising prices, aka inflation. and that was the biggest single reason given for any particular outlook in the survey was the negativity around inflation. So 36% said that was their primary concern. And then another bullet point from the report was that most consumers are not thinking about and not buying as many durable goods, which when you think durable goods, think of things like cars, washing machines, washers, dryers. I guess I already said that. Dishwashers, stuff like that. Even microwaves, TVs, things that you use for a long time. You don't just use once and throw away or consume like food. Those are durable goods. And so most consumers are not thinking about purchasing. They're not planning purchasing of those kinds of goods because of the recent increase in prices. And then the other thing to point out about this survey, which we will see on a chart, is that it's sitting at its lowest level since 2013, the index value is. And so we'll look at a bit longer run series of that. This data goes all the way back to 1978. That's when the University of Michigan started collecting data on this survey, or started running the survey, rather. That's a better way to say it. And so a couple of things that I wanted to go ahead and point out here is that this is 2013, this big, huge trough right here. A lot of things were going on at that point. The Eurozone was in a huge debt crisis that put them into a pretty severe recession, and the East Asian economies were also falling off. So there was a lot of growth in China after the great financial crisis in the US that kind of helped pull the world out of recession, and then there was a reversal of fortune there in the mid 2010s, which made things quite pessimistic. And so we're sitting at a level right now in 2022 that we haven't seen since this type of era in 2013. And then the other thing that I want to point out is that these yellow bars, these shaded yellow bars on the graph signify United States recessions, which is a time when the economy shrinks, unemployment goes up, and less stuff is being produced. In other words, the human standard of living in the U.S. is declining, which also usually coincides with a recession overseas. But anyway, this particular shaded yellow bar is the Great Recession of 2008, which preceded the Great Financial Crisis of 2008, and the recession lasted from 2008 to 2009. And so the index level at this point was not much lower than it is right now. So what that means for what could be around the corner, and basically the word in the financial media and just based on the data actually is that a recession in the near future at this point is kind of a mathematical certainty. And if you look overseas to what other currencies are doing, which is an indicator of how other economies are doing, things like, well, specifically thinking of Japan, of China, and of the Western European countries, the larger countries like Germany and the UK and France, countries like that. Most of the world is already entering a recession, and growth has slowed down significantly in China to the point where it's probably actually reversed, and the data that they put out there is not correct. Usually it's usually massaged as far as their statistics goes by their government to make it look like more than it is. So most economists are looking at the situation in China and saying, yeah, that's probably already in a recession, or at least the economists who actually pay attention to foreign economies, which is not most of them. But anyway, so this trend in consumer sentiment is very, very recessionary. Or another way of saying that is bodes for an economic contraction is essentially what I'm getting at, and a pretty big one if this indication of an extremely weak economy in 2008 and an almost equally weak economy in 2013, because 2013 was prior to any major recovery in the job market after the Great Financial Crisis and the Great Recession. So that was also a very weak economic time as well. So basically what we're seeing from the Consumer Sentiment Index is that things just really are not great. And then I just have one more chart which is going to zero in on the last 5 years of data with this particular indicator. And I just want to point out that between 2017 and 2019, so the 3 years inclusive leading up to the pandemic, this figure was hovering between 95, 96, 97 on average for all of these months. And this was associated with a really strong recovery in the job market. We had record low unemployment. The number of unemployment claims, as I pointed out yesterday, was super, super low. And this corresponded to very high positivity among the average American consumer, according to this survey. And now what we see in the recovery since the pandemic is we've certainly gotten the same good job numbers. The unemployment rate is historically low. It's 3-point-something%. And we see even more historically low unemployment claims on the other side of that data set, or in another job market data set that's commonly looked at, the one that I mentioned in my note yesterday. But the consumer is actually saying, no economists, no data collectors, the situation really isn't that great. I'm pretty worried about what's coming down the pike, speaking as the average consumer. I'm pretty worried about what's going and coming around the pike. The cost of living for me is getting more expensive, and the job market maybe doesn't look that great. And I'm pretty worried about what's going to happen a few months or a few years down in the future. So a pretty significant thing to keep in mind. And if you notice that this downtrend that we've seen basically since June of last year, so for the last 11-12 months, has corresponded with the fall in real income. So if you look at a chart of real disposable income in the entire economy as it's estimated on a monthly basis, you will see that the turnaround in that figure was right here around the mid to late 2021. I think it started in September of 2021 maybe, and it had kind of leveled off throughout the summer of 2021 because that's when inflation started to pick up. So even though people's pay might have been increasing or their dollar wage might have gone up a little bit, the rate of increase in prices was such that their real disposable income has actually declined and has been for about the last 10, 11, 12 months. So just something to point out there. And just one more thing, one note to end on, is that for all of the experts out there who watch the economy and pay attention to this data and have sophisticated models where they try to predict what's going to happen next, most of those people have not been forecasting a recession for the last 2 years. In fact, most of those people have only come around to the idea that a recession is on its way in the last maybe 3 to 4 weeks, as I've been seeing in the financial media and from journalists and reporting, and some of the economists who actually do publish things online and talk on podcasts and things like that. But the consumer seems to have sniffed out that pattern well in advance of when all of the, such and such the experts have. And so that's really interesting, and that's why I think that this data point is particularly valuable, because again, it's kind of like taking a pulse on the people who are in the economy and depending on it each and every single day, and have, I think, somewhat better idea of what's going on, more so than people who just, kind of sit around and look at charts and work in industries that are relatively protected, like academia per se. So that's all I have for you today. I want to wish everybody a happy Friday and say thank you very much for tuning in. And I'll be back next week with more daily notes and some deep dives. So have a pleasant one, and I'll talk to you later. Bye.